Where do your insurance premiums go? Other people's money. When you buy any kind of insurance, car insurance, homeowners, life insurance, medical insurance, your money essentially is being pooled with a bunch of other people who bought that insurance. So now, depending on the kind of insurance you bought, that insurance company might be using that in specific ways, depending on the kind of insurance. And then, depending on the specific insurance company, they're going to use that premium in certain ways, like they might invest it in their own portfolio of, say, for aggressive investments so they can earn on your money before they might have to pay a claim out to you so that they can build a surplus and so on. But more on that later. When the main thing you're doing when you buy insurance, any kind of insurance, is you're pooling the risk with other people who also bought that insurance. So if you pay $100 a month for car insurance so that you don't have to pay the full $50,000 to get a new car, you basically just got, 100 of your friends to also put in $100 a month. Now, what's 50,000 divided by 100? What is that? 500? Yeah, 500. So it's kind of like, imagine if you paid $100 a month for car insurance and you just had it for 1 month, and then God forbid you get into an accident or something, and then the insurance company gives you $50,000 to buy a new car. Well, the way that it works most efficiently is that 99 other people also paid $100 a month, and then you were that one person out of 100 that got into an accident. So instead of you having to pay 50,000 for the car, you only had to pay 100. And then you keep paying your car insurance, and it might increase and all that stuff because you got into an accident. But again, more on that later. But that is something that most people don't know about when you buy insurance, and I would say the hidden beauty of buying insurance, because whenever we talk about investments and growth and trying to grow our money, we want our money to multiply. Now, we don't want to get into a head-on collision or have our house burned down in a fire for us to grow our money. But, unfortunately, those things happen in life, and it would be nice to not have to pay all those bills on our own. So that's why we pay $100 a month instead of, hoping that we never have to pay 50,000, in this case for a car. So it's really convenient that now you can get 99 of your most distant friends, really not your closest friends. You get 99 of your most distant friends to also pay $100 a month. Now, here's the other nice thing about that too. It's that, let's say it was you and 100 of your friends, and you didn't have health insurance, life insurance, whatever. Well, we have programs for that. It's called GoFundMe, right? So GoFundMe is kind of like GoFundMe is similar to insurance. You're pooling that risk with other people's money. The only difference is that normally when people are on GoFundMe, something bad has already happened. And by the way, I'm not talking about people trying to raise money for like a missions trip or something like that. We're talking about, somebody had a heart attack and had to go to the hospital or got an infection, or several months ago, I saw a post, someone in my social circles, they posted about someone who had an accident on a hiking trip and got rushed to the hospital. So they're asking for money. Okay. Now, things like that, hopefully insurance is going to cover things like that, but sometimes the insurance doesn't cover it. So that's why we have things like GoFundMe. Now, if you don't even want to buy insurance, yeah, you can get on GoFundMe, but the problem with GoFundMe is that something bad already happened and you kind of need the money now. And then also, what if people don't want to contribute to your GoFundMe? If you have insurance, everybody else was already paying a premium just like you. And and it was a lot of people paying the premium. If you get on GoFundMe, I mean, this particular uh, this particular fund where this gentleman, I don't know this guy, but he had a hiking accident. I don't know how many people contributed to that fund by the time I did. I didn't look. If I did, I don't remember the number. But I promise you it's significantly lower than the amount of people that are contributing to, for example, life insurance, that are at the same company, who are the same risk pool as you. So you've got a lot more people contributing, and they're contributing on a monthly basis. With GoFundMe, it might be a one-time thing. Somebody will just put in $50 and they're like, all right, I gave. Okay, you figure out the rest. But if you've got life insurance, I mean, there's people paying tens of dollars, hundreds of dollars, thousands of dollars a month for their insurance, and those premiums get pulled together to cover you. And you don't have to ask them for money. You just got to pay your premium. So it's risk pool. It's other people's money. And again, back to investments. People love other people's money. When we talk investments, that's what debt is all about. You know, the idea of, like, why pay cash for a house when you can just use the bank's money and get the house now, even though you don't have the money yet. You know, why save up and pay cash for a car when the car is just going to depreciate, and you know, you're not renting out the car or anything or using it as an asset. It's just taking money from you: the gas, the insurance, the upkeep of the car, the registration, all that stuff. It's just taking money from you. So why would you take your hard-earned invested money when you can just loan it from the bank? And okay, there's reasons why people want to pay cash for a car, because you don't want to finance a liability, right? But the point is, you're using debt, you're using the bank's money instead of your own, right? I want to leave my capital in an investment to earn hopefully more than that interest rate that I'm paying for that money that I got to finance the car. So that's other people's money, okay? Then there's covered debt, okay? So let's say I finance that car, or let's say I finance a house. It's even better. Everybody gets into real estate. They finance their house, and they get rental properties, or they get a roommate and have someone help pay the mortgage. You're using other people's money to cover your debt and to hopefully turn your liabilities into an asset as quickly as possible. That's OPM, other people's money. Now think about this math. If I take, let's say I've got for easy numbers, let's say I've got a $1 million house, $100,000 house, very, very, very cheap house in the US at this point. But for easy numbers, let's say I have a $100,000 house, and I put 20% down on it. Okay. Well, I just took $20,000 to go get, and technically an asset, because it's a positive on my balance sheet. That house is now, it's worth $100,000. So now I have debt. I have $80,000 of debt. But just looking at the assets, I took my $20,000 and leveraged some money to get a $100,000 asset. So again, there's some debt there, but I basically just 5x'd my money. So I went from 20,000 to 100,000. I 5x'd my money. I've got to pay down that 80,000, and that'd be nice to have a renter or a roommate or something to help pay off that 80,000, and hopefully there's appreciation on the value of the property. But I 5x'd my money. Okay. If I take $20,000 and I put that in an insurance policy, and in this case, let's use life insurance. Okay, because I don't know how many people are dumping 20,000 into car insurance like one fell swoop. I've never heard of that before. Or health insurance, or even like disability. Disability you can leverage a lot. But you might never get disabled. With life insurance, you're going to die. So it's easy. You're going to die. With the house, you're going to live in the house. With life insurance, you're going to die. So we're going to use life insurance. So if I take $20,000 and I put that into a life insurance policy, unless I'm really old and really unhealthy, that money is leveraging a whole lot more than $100,000. Why? Because that $20,000 was also pooled with tens of thousands of other insurance policy owners to go to that company and pull it together and make sure that if something happens to me, or I should say when something happens to me, there's going to be a lot more. There's going to be a lot more. Just speaking for a friend, I know someone who's put $20,000 into a life insurance account, and it's leveraging about $400,000 of life insurance death benefit. And that's liquid money that bypasses probate, by the way. So more topics for later. Other people's money. So the younger and the healthier you are, the more of other people's money you can use. Kind of like with using debt, other people's money, like going to the bank to get debt, or maybe borrowing money from a friend. Maybe not borrowing money from the friend. If you have better credit, if you've got good credit and you've got no debt otherwise, and you go take out a loan, you can leverage a lot more of other people's money because you've got good credit. You're showing your credit worthiness. You pay all your bills on time, your credit card bills on time. It's good. So the degree to which you can use other people's money improves, the better your financial situation improves. With life insurance, the better your health is and the younger your age is, and the more female you are, by the way, females live longer than males on average, so their life insurance premiums are lower, then the more other people's money you can leverage. And you can leverage a whole lot more with insurance. If you look at an illustration of of pretty much any life insurance policy, if it's and we're talking cash value life insurance, by the way, not term. Term, you're leveraging even more because term is designed to have a very low premium with a very high death benefit. But I'm talking about an insurance that you can use while you're alive, not term, because it functions more similar to real estate and the other situations where we use other people's money, like the equity inside the house. So a lot of times, if you look at an illustration of a good cash value life insurance policy, on day one, that death benefit is over 1,000x. Now, hopefully you're not going to die the next day when you buy life insurance, or else there would be quite a bit of the life insurance company would use their contestability provision provided by the federal government. They would use that for sure. If you bought insurance and died the next day. But even if you died 10 years from now, 20 years from now, we're still talking about double-digit returns on your money. Risk pooling, or putting money together.